Hello, students. How are you? Okay, let us start our discussion on accounting and finance course. Today's lesson is regarding about communicating the users of accounting information system. Before discussing this users communication through accounting information system, let us discuss what we have discussed in the last class, uh, which is the business transaction and the accounting equation. In that topic, we first discussed about the meaning and the types of business transaction. That means what we mean the business transaction, its definition. We discussed in the last class. Another features of the business transaction we discussed. Another types of business transactions, like internal transactions and external transactions, discussed. Some examples of types of business transactions: purchase transactions, sales transaction, payment transaction, receipt transaction, transfer transaction, and loan transactions are some examples of types of business transactions. Another topic that we discussed is the elements of financial settlements which are affected by the business transaction, such as directly related to the financial position, or what we call the balance sheet, like assets, liability, and equities, and directly related to the income statements, like revenues and expenses. And we have discussed each elements, uh, like equity, income statement, asset, liability, expenses are some financial statement elements affected by the business transaction. Also, we discussed the transaction analysis. Transaction analysis. Here, transaction analysis are very important in order to record economic events in the books of accounts. First, we have to analyze. This analysis affects account equation, which is asset is equal to liability plus owner's equity. And some very important questions that must be asked in order to analyze the business transactions, like what are the names of accounts affected in the business transaction? What is the effect of each account? Effect of each account means decrease or increase. What is the classification of each account? Classification means accounts are classified under asset or liability or owner's equity or revenue or expenses. These are some classifications. And what is the increase or decrease side of each account also? You have to know the increase and the decrease side of each account. For all asset accounts, increase side, all assets decrease side, all liabilities increase side, decrease side. Such questions must be asked and answered. And the last, what is the amount of each account affected in the transaction? Amount of each account. What you have identified accounts, amount must be identified. And also last, you have discussed, or we have discussed the examples of transaction analysis. I gave you some transaction, one transaction, yes. Then we have discussed this example. And lastly, we discussed the increase or decrease side of each account. The increase or the decrease side of each account. For example, for all asset accounts, the increase side is debit side. The decrease side is the credit side. All liability accounts, the increase side is credit side. The decrease side is debit side. For all equity accounts, the increase side is credit side. The decrease side is debit side. And for all revenue accounts, the increase side is credit side. The decrease side is debit side. For all expense accounts, the increase side is debit side. The decrease side is credit side. And At last, you discussed the transaction analysis and the accounting equation, the basic accounting equation. That basic accounting equation, assets is equals to liability and owner's equity. Business transaction affects this. Assets is equal to liability plus owner's equity. That means how it affects. It affects by increasing or by decreasing asset account, or by increasing or decreasing liability account, or by increasing or decreasing owner's equity. By any means, this equation must be the equal. That means asset sides must be equals to liability plus the owner's equity. Whatever business transaction analyzed and recorded, then that analysis affects this assets or liability or owner's equity. You discussed this. And today lesson just is regarding about the communicating the users. This is the last topic in the unit 1. Therefore, in order to discuss this communicating the users of accounting information, let us start overview. Here, accounting information is communicated to the different users of the financial information using what? The financial statements. Financial statements. The accounting information is communicated to the different users of financial information using the financial information, using the financial statements. Through financial statements, accounting information is communicated with the users of accounting information. Here, what we have to understand is the objective of accounting. Here, objective, or the what we call the goal of accounting, always to provide the useful information, the reliable information for the decision makers, for the users of accounting information. This is the objective of accounting. Therefore, this useful information is used for users of accounting information through communication through financial statements, which are known as the financial reports. Different users. Who are the different users? The investors, the bankers, or what we call the creditors, the suppliers for the business organization. Those supply the resources, inputs, are known as suppliers. The government agencies, the labor unions, employee of the organization, management of the organization. These are the different users of the accounting information system. And here financial statements include the financial statement, what we call the financial accounting information, what we call include the income statement. Another name for the income statement is profit or loss statement. The owner's equity statement. Another name for the owner's equity statement is the capital statement. And the statement of financial position. Another name for the statement of financial position is balance sheet. And the cash flow statement. These are basic financial statements, basic financial reports. Okay, here the users of these reports want this information to make decisions. What type of decisions? Let us see. The investing decision, for example. Investors need this information to invest, to make investment decision. Therefore, investing decisions, approving loan decisions. In order to approve loan, the banks and other creditors, in order to approve the loan, they need information which shows business organizations' assets and the liabilities and their liquid assets through balance sheet statement. Balance sheet. Assessing taxes, for example. Government need financial information in order to assess tax. Assessing tax is another decision. Negotiating labor contracts. Labor unions need account information to make such decisions. And establishing budgets for them. Management of the organization need accounting information in order to establish the budgets. So these are some of the some of the goals or some of the decisions of the users. Okay, this is the overview. In order to discuss the communicating users, let us start from the meaning and the importance of financial statement. Since financial statement is a communication way of communication with the users, therefore, let us discuss the meaning and the importance of financial statements. Financial statements, as I told you, the first one is the statement of profit or loss, what we call the income statement. It is the summary of the revenues and the expenses for a specific period of time. For a specific period of time, such as a month, a quarter, semi-annual, or a year. A specific period of time. It includes the summary of all revenues and all expenses. Here, revenues are generated, classified as revenues generated through ordinary activity of the organization, and revenues, some other revenues are known as the revenues which are generated without ordinary activity of the organization. Therefore, revenues related with generated with ordinary activity of the business and the non-ordinary activity of the business, what we call income and other incomes. Expenses like that, expenses also ordinary activities of the business and the non-ordinary activities of the business. These are summarized and reported in statement of profit or loss statement. Another is statement of owner's equity. This is the summary of the changes in the owner's equity that have occurred during a specific period of time also. Changes. It means at the beginning there is some amount or balance, then at the end of the month or at the end of the quarter, at the end of the semi-annual or at the end of the year, this beginning capital account changed. These changes are reported by statement of owner's equity. Therefore, the readers can get information why this capital account is increased or why this capital account is decreased. The reasons also are presented in the statement. Another statement is statement of financial position, or what we call balance sheet. This is the list of the all assets, all liabilities, and the owner's equity as of a specific date. Here, balance sheet is for a specific date, not for a specific period of time, but for a specific date. Usually at the close of the last day of a month, or last day of a quarter, or last day of semi-annual, or last day of the year. But it is for a specific date, not for specific period of time. For a specific date. Okay. Another one is the statement of cash flow statement. This is the summary of the cash receipts, received cash and cash payments, paid cash for a specific period of time. Okay. Let us discuss the importance of financial statement. Important. Why these statements are important? As I told you, in general, the decision makers need these reports. Let us discuss specifically. Statement of profit or loss reports what? The profitability of the business. It discusses or it reports the profitability of the business. That means the performance of the business activity, the business organization, performance in total. By what? By comparing the all revenues and the expenses for a state period of time. Because the comparison between revenues and expenses are reported or shown on the statement of profit or loss. If the revenues of a period exceeds the expenses of that the same period, then net income is the result. Net income will be results. And if the expenses are greater than the revenues of a period, then we say there is a net loss. Net loss. Therefore, it reports the profitability of the business or the performance of the business by comparing revenues and expenses. In accounting, profitability is measured for a period of time than on a daily basis. Period of time, but not a daily basis. Profitability is measured for a period of time, but not for one day or only one day. It is impossible to measure the profitability, but for a period of time, that maybe for 1 month and more than 1 month, it is possible to compare the profitability. Statement of owner's equity here. Statement of owner's equity summarizes the changes, or changes here means the increases or the decreases in owner's equity for a specific period of time. Another one, statement of financial position, what we call the balance sheet. This reports a company's assets, current assets, fixed assets, and intangible assets. Also liabilities of the organization, that is the current liabilities and the long-term liabilities. And the intangible assets also reported in the financial statements. Another owner's equity also, that is increased or decreased owner's equity through the operation, also reported in the balance sheet, what we call statement of financial position. This balance sheet presents the company's total assets and how these assets are financed, the way of financing of these assets. That means either debt financing or equity financing. It shows or it presents for the readers, for the users of the report. Here, in financing is possible through equity financing or debt financing. If there are many liabilities in the financial position or in the balance sheet, when compared with assets, then that assets are financed by debt financing. And if liabilities are very, very small in amount, when we compare with assets, then that assets are financed by equity financing. Therefore, it shows the way of financing also. The statement of financial position is based on the fundamental equation, that means account equation, assets is equals to liability plus equity. Another one is the statement of cash flow here. This statement of cash flow summarizes information about the cash inflows that are in receipts and the outflows that are the payments for a specific period of time. This summarizes the receipts and the payments of cash for a period of time. This cash flow statement reports the following. It reports the following for the users of the account information. The first, the cash effects of company's operation. The cash effects of company's operation during a period. Second, it presents its investing activities. Another, it is financing activities. Another, the net increase or decrease in cash during the period. And last, the cash amount at the end of the period. The cash balance at the end of the period. These are reported through cash flow statement. It also it is reporting the sources, uses, and the change in cash. It is useful because investors, creditors, and others want to know what is happening to a company's most liquid resources. Therefore, these are the informations that the decision makers use through communication of financial reports. Let us summarize this unit, because this is the last topic in the unit. Let us summarize. In the unit totally there are 4 objectives. The first objective is understanding the meaning and the nature of accounting. In this unit, the first objective is understanding the meaning and the nature of accounting. Therefore, in order to understand the meaning and the nature of accounting, you discussed accounting definition. That it is the process of recording, summarizing, analyzing, and reporting the financial transactions, economic events of a business entity to the interest decision maker. That is the definition we discussed. The nature of accounting are it is a process. Accounting is a process. Accounting is an art. It is a means but not an end. It deals with financial information and the transactions, and it is an information system. And the major activities of accounting include major activities of accounting: identification, recording, and the communicating or communication. These are the first objective. Another objective in this unit is understanding the effect of business transactions on the accounting equation. So as to understand the effects of business transaction on the accounting equation, we discussed the accounting equation by itself, what we call the balance sheet equation. That states that assets is equals to liability plus equities. Every transaction affects this equation by either increasing or decreasing assets, liabilities, or equities. This is known as the business transaction analysis. When a company purchases inventory on credit, this increases what? Assets, what we call inventory account. And it also increases the liabilities, that what we call accounting payables account. Thus, this maintains the accounting equation balance, make it balance. The third objective of this unit is understanding the principles and the concepts, what we call generally accepted accounting principles, GAAP. Here, generally accepted accounting principles are a set of standardized principles and guidelines used in financial accounting. The principles ensure the consistency, the comparability, the transparency in financial reporting across different organizations. Generally accepted accounting principles provide a framework for recording and reporting financial information accurately so that the stakeholders can make the informed decisions based on a reliable data. And the fourth and the last objective of the unit includes the understand the users of account information. In order to understand the users of account information, we discuss that the broad two classes, groups of users, that is the internal users and the external users of account information system. Internal users include the management and the employees of the organization. External users include the investors, creditors, government agencies, regulatory bodies are external users. Each user group has different information needs. They need not the same information, but different information needs. The users use the financial statements to assess the company's performance and the financial healthiness and the compliance with the regulations. These are all about the unit, this unit. That's unit one, about the fundamental under the first unit. We discussed complete in this topic.